Systems are a go. If you can hear me, say g'day in the chat. My name's Owen Rask. Welcome back to Selfwealth Live for this Wednesday night, 6 p.m. It's always a good time of the evening, and hump day, the top of hump day, if you like, we get a chance to talk investing, which who doesn't like that? If you're joining us live in Selfwealth's YouTube, on your Selfwealth's YouTube channel, please, there's a poll at the top of the live chat functionality there. And the poll says, where do you shop for groceries most often? When there were 10 people who had submitted their votes, it was Woolies at about 50%. And now that it looks like there's about 36 votes so far, and Coles is coming out ahead. So it's a pretty simple question. Where do you shop for your groceries most often? And I think we can talk about this many different ways because we're talking about supermarkets tonight. So that's why I've used this example. But it's interesting how we get, data points as analysts and as investors. And oftentimes it's just straight up through surveys, just like this one. So tonight we're going to be talking about some ETFs. Put this on Do Not Disturb. And we're going to be talking about Metcash. We're going to be talking about this thing called the 7% rule, which is for passive income investors or for investors who are seeking dividend income. This is the thing that you need to be aware of. We're going to talk about how that works. And I'm going to do a bit of screen sharing and answer any questions that come through as well. G'day, Jeremy, Ray, Pima, Benny, Pocket Full of Shell. Full of Shell, you said, love my South Melbourne market. Only shop at supermarkets for things like Pino Clean wipes. Very well done. I've heard South Melbourne market is very good. So you must be in good company down there. Chris, wine poured and ready to go. Well, Chris, I must admit, I feel like I should be able to have a wine, but then again, it probably doesn't really, it's probably not right. There's probably something about money and investing and having wine. Maybe if we do an event sometime in the future. So lovely to see you all. As always, I'll start off with my joke. So my joke, because we're in the spirit of tax and it's, everyone's thinking about tax returns or, geez, what kind of tax bill do I have to pay? And what am I going to do with my money? Maybe I'm going to go overseas. Maybe I'm going to go for a holiday. Maybe I'm going to put it towards something around the house or whatever. It's a tax joke. So there are so many tax jokes. I've got to admit, when I look for investing jokes, I'm scouring through hundreds and hundreds to find anything decent. And even I only get a 5 out of 6 from half of you anyway, a 5 or a 6, I should say. So the joke for tax is there were so many to choose from. This one's an easy one. Why are accountants always tired after work? Because their job is so taxing. That's my joke for tonight. I hope you like it. I feel like Jeremy's going to really like that one. That one's for you, mate. And so just a bit of housekeeping. Obviously, any of the questions that I answer in the chats tonight is strictly limited to general financial advice only. I don't know your personal circumstances, so I cannot give you that type of advice. You will have to see a financial planner for that. You can visit ASX Money Smart website and search the financial advisor registers there. And as always, if we talk about ETFs or things like that, it's important to read the PDS. And if you have any questions on the type of things that we can and can't answer, the best place to go is the Financial Services Guide. That's for Rask, that'll be my one, or for Selfwealth on either website. So tonight, like I said, we're talking dividends, we're talking income. One of the things, it's almost June 30th, so Selfwealth Premium, which is what you see when I log into my account, which I'll do in just a minute. Selfwealth Premium is what you will see in my account. I'll just log in, which is probably a good start for tonight's session, given that we are going to be looking at companies. Selfwealth offering the premium subscription until June 30th, I believe. You can get in, and you can get in at a steep discount, and you can get some trades in that, and you get some of the data and all that stuff that you see here on my screen right now. Okay, so now that that's done, let's start talking about our topics tonight. So as always, I'm going to do a giveaway. We're going to do a giveaway of the Value Investor Program, which is the thing that you would have seen me show a few times now. And the Value Investor Program is just an online training course that I put together for people to learn how to invest. It's usually $499. We give that away tonight, as well as some trades through Selfwealth. So if you guess the 5, 4, 3, 2, 1, you guess the most traded share. We're not doing ETFs tonight. No ETFs. The most traded share and most bought and most sold, you will win the award. So it is a very, very, very interesting list tonight because John, it's fantastic to see you in the chat. I just noticed that you're in the chat. It's great to have you with us, John. All the way from Europe back to Melbourne. Great to have you with us. And Paul, I see you're watching from Denmark, not the one in WA. Okay, interesting. It's so great to have everyone back with us. So, Jason, you've already got in quick. You can put your guesses into the live chat. You've guessed most bought BHP, most sold Woodside Energy. So what we're going to do is we're going to start, and I've got my list here with the most bought 5, 4, 3, 2, 1. Then we'll do the most sold. Now I'll give you one tip. There are only shares in this list. They're all from the ASX for both lists. And the other thing to keep in mind is that this list of shares or companies is actually very, 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 I guess, standard in the sense that you would expect this list if you just looked at the largest companies. So I hope that doesn't give too much away. That's for the most bought. The most sold is a different case altogether. So let's get to it. Let's make sure that I'm sharing my screen. And yes, you can see it in at number 5. We've got Fortescue Metals Group, the big iron ore / future energy play. The company has been the most sold recently, so it's good to see it in the most bought. It's basically turning on the dime with commodity prices is what Fortescue does, as do many of the other miners that are on the list. So, we see Fortescue in at number 5. I've talked about that quite a bit lately. In at number 4, not surprisingly, we've got BHP following it right up at number 4, most bought inside Selfwealth. These two were it was neck and neck between Fortescue and BHP. Let's just check out the reasons why people are buying this. It's been a very topical thing lately. Obviously, people think about it for dividends. They think about it for diversification. And as you'll discover tonight, it also features very, very heavily in some of the big dividend ETFs that we're going to cover tonight. So 65% of people are buying and they're saying the stock is undervalued. It's a good dividend paying stock in at number 2. CBA is in at number 3. So CBA is often the biggest position in these dividend paying ETFs I discovered today. And you can see here, 60% of people are buying. The reason they're buying, number one reason, is good dividend paying stock. Makes sense. Some people say the stock is undervalued as well. We can talk more about dividend valuations and how to value a bank share in the future. But for now, we've got number 2, which is ANZ. ANZ in at number 2 most bought. I don't ever been this high. 31% of people saying the stock is undervalued, and we see more buying than selling. It's actually been a really interesting week, I think you'll agree, for investors, because this is probably the first time when we've seen in a few weeks a lot of positivity from some investors. So we've seen some investors saying, now is a good time to buy, which is interesting because in recent weeks, it's been very negative. There's been a lot of negativity around. So I'm glad some of us have come to our senses and we're looking forward to the future. Christopher, I can see you on Facebook there. You've said CSL. Jason, makes sense. Nice pun. Got to love that. Danica, you said most bought Macquarie. Interesting. JJ said SYA for most bought and LKE most sold. All right, well, I'm going to get to number 1 now. So number 1 most bought on my list is a very boring company, a company that we've covered a lot, Westpac. It is a company that has basically gone nowhere from a share price perspective for 10 years, but it's paid dividends and I mean literal dividends. The stock is undervalued, say 34% of the people who are buying. It's a good dividend-paying stock, about 23% of folks in that. And of those who are selling, by far, people taking profits. So I don't know when they bought, but they're taking profits. So Westpac, ANZ, CBA, BHP, Fortescue. That's our top 5. Did anyone guess Westpac? I need to jump back into the chat. I've got my notes in front of me. Did anyone guess Westpac? It's such a... Oh, Jason Marshall, you certainly did. Most bought Westpac. Fantastic. Jason B came through with BHP. Close. Matthew guessed VAS. Remember, Matthew, that would have been the case had we included ETF. So Jason Marshall. Genevieve says, what a boring list. Yeah, it was. There's nothing interesting. But there are no points for originality in investing, Genevieve. So now we'll get stuck in, because we've got a lot to get through tonight. I'll get stuck in straight into the most sold. So if you are a regular of the show every Wednesday night, there will be some familiar names on this list. So there will be some familiar names as I just click around randomly on some things. There will be some familiar names. Now, what's also interesting is that we're starting to see some of the lithium companies appear more on the sold than the bought side of things. So we're starting to see it for them rolling around. So, okay, let's get into it. In at number 5, we have Core Lithium. Core Lithium is an early stage minerals and mining business. It is primarily involved in lithium. Let's have a look at the stock price chart recently. That's 10 years. Let's go 5. So we can see here a sharp downturn for Core Lithium. Was a company that did feature in our top, I think it was our top 10 ASX shares over the past 10 years, due to the run-up of share price it's had from such a low base as well, we've got to admit. In at number 4 is Pilbara Minerals, staying on the theme, down 4% today. Pilbara Minerals, much more advanced company, actually produces revenue, actually has a bona fide business model, and is growing pretty well. In at number 3, it's ANZ. ANZ, big bank, not as big as it used to be when the company was expanding into Asia and has since pulled back. Now it's a much smaller bank, and let's just have a quick look at its market cap to get a sense. Nowadays, ANZ is worth $62 billion. For every share that's available in ANZ, if you were to buy them all, it would cost you $62 billion. Well, it might cost you a little bit more than that if you have to do a formal takeover, but $62 billion. In at number 2, we have Qantas. Qantas, you may have heard in the news, is scrapping some of its flights that is going, I think it's primarily from Melbourne to Sydney and vice versa. One of the busiest routes in the world is this one from Melbourne to Sydney. And it is cutting back to handle the higher fuel prices, which, as you may remember, a few months ago, we did mention that as fuel prices go higher, that can actually be a negative for many airlines that pay through the roof for airline fuel. So we've got a boring list. Vanessa's guessed LKE is the most sold. Jason says, I like boring. Boring equals safe, but the banks could get more interesting as rates rise. What do you mean by that, Jason? I'd love to know what you mean. What do you mean by interesting? Do you mean, I feel like interesting is a word that could go one of two ways, like interesting or interesting. And then it just confuses me even more. What do you mean? Do you mean bad, good, indifferent? I am interested to know what you mean by that. Pocketful of Shell explains, explains why my flight keeps getting rescheduled. It is a pun. It is a pun there, Rob. I can see you in the chat there. Genevieve said, the gold sector has been buried alive this week. Nick Law has guessed Tyro for the most sold. Interesting, because they've just announced the resignation of their managing director. Jeremy, I'm still going to go with Westpac. Okay. Well, I'm afraid to say, well, not afraid to say, it's actually positive because someone did guess it. LKE is the most sold. Lake Resources coming down from the clouds. It has really, really, really reversed all of those gains that had just such a short time ago. Lake Resources, we discovered, I think it was last week or the week before, we discovered a few different things. We discovered that on June 20th, the managing director would be stepping down and I believe, could be mistaken, selling some shares. They have appointed an executive chairman, so it seems abrupt. It was an interesting week. So, Drats, says Jeremy. Yep, I hear. Maybe next week, mate. But I know you're here every week, so you're going to win, and probably many more times. So, keep your chin up, mate. Okay, so LKE most sold. Just to recap, the most bought and most sold. Most bought inside Selfwealth over the past week included, in order, Westpac, ANZ, CBA, BHP, and Fortescue. Just to give you a sense of how much bigger CBA is than ANZ these days, $159 billion versus $62 billion for ANZ. Most sold, we've got Lake Resources, followed by Qantas, ANZ, Pilbara Minerals, and Core Lithium. So lithium on the nose this week, as they say. Okay, so I've got a little bit of stuff that I prepared for you in advance, but I want you to just send me your questions, fire them into the live chat there, and I'll get to them throughout the evening. But we wanted to talk about dividend income. There was a request that came through, I think it was last week, when I called for topics. By the way, if you have any topics you'd love me to cover, please just put them in the chat now. Rob and I really like this feedback, or any guests that you want on the show. I've reached out to a couple of guests in the last few days who should be appearing, and they're pretty good guests to have on the show in the next couple of months. So keep your eyes peeled. Okay, so the question was last week, I think it was, or the week before, was effectively, if we're looking for dividend income, how do we get that? How do we get dividend income from the stock market? Now, we've talked a lot about ETFs and how ETFs can be used as opposed to individual shares. And you may remember the analogy that I've given, which is just that ETFs are just like a basket of shares or a basket of bonds or a basket of whatever, and you buy the basket. You don't buy the individual thing that's inside it. And then we learn that there's actually another ETF out there that's like a basket of a basket, which is some of those diversified ETFs, which have other funds inside of them, which then hold the shares. So it's like two layers of baskets, if you like. So the reason that I'm bringing this up tonight is when we talk about the stock market, typically what we want, and this is not just from the stock market, it's from any market really, is we want two things. We want capital gains, so we want our investment to go up, and we want dividend income. So a good example is CBA. CBA has been alongside CSL, Fortescue, BHP, and you probably say a few of the REITs. This has been the standout company over the past 20 to 30 years. Coles too, but it was bought out by Wesfarmers. Wesfarmers would be another good example, and so would Washington H. Soul Pattinson. So here we can see a company's share price that has steadily gone up over time. There's been some ups and downs, of course, but it's also paid a rising stream of dividends. Now, the really important thing here is if we go into the financials tab and we'll bring up dividends, I'll just uncheck those, and we'll drop down here. Now, the really important thing about the dividends alongside the capital gains is that you have franking credits. Franking credits are a tax benefit we've discovered over recent weeks that is a tax credit that's stored against your name at the Australian Tax Office. So then when it comes around to tax time, i.e. now, and you lodge your tax return, those credits are stored against your tax file number, assuming that you've held your shares for more than, I think, 45 days, and you are eligible to receive franking credits. The company is basically paying the tax ahead of time for you, which you can then use to offset some of your income and some of your taxes in other ways. So it's a great benefit. So a company like it's a great example. It's paid dividends along the way, but the share price has also gone up. Another fantastic example is ARB. ARB is the Australian bull bar company named after Anthony Ronald Brown, who was the founder of the company. He drove around Australia. We learned this in one of the first Selfwealth Lives. He drove around Australia and realized in the 1970s that he needed a bull bar for the extreme weather conditions in Australia. So he set about building the best bull bars, and that has since become an international brand where it builds bull bars specifically for individual cars and makes and models all around the world. And you can see here, this is revenue. Maybe I'll get rid of those two and I'll go down to dividends once again. Here we go. DPS stands for dividends per share. And we can see dividends consistently growing from ARB. But if we go to the share price over the long term, also, recently it's been falling, but also growing. So we can see 10 years ago, you could have got ARB shares for around about $8. At the height of last year, they were worth 52. So here we go, more of the same. So we want this. Now, the thing is, when we look at an investment portfolio, it's important to recognize that it's not just the stock market which produces both of those things. It's not just the stock market which produces dividends or income and capital gains. There are other markets which do much the same. So we have bond markets. We have even the humble term deposit can be compounding in the back of your in your bank account, and in the back office, it's just constantly just ticking over. Every year, it might pay you 3% in interest. You keep that interest in there, you roll it over again, and it keeps compounding, and so on and so forth. There are many different markets that basically make up a person's investment portfolio. Last week, we talked about how bonds make up a part of a portfolio, and they are a very important part. You could also have, international shares, Australian shares. You could have emerging markets like Chinese shares or the whole kind of Latin America region. You can have bonds from Australia, bonds from the United States, bonds from Europe, wherever, and you can put all these together to create your own portfolio. Now, one of the things that people probably don't realize is that some of the biggest investment companies in the world, such as Vanguard, which we see here, and BlackRock, which we see here. Now, this chart might look a bit scary, so bear with me for a second and I'll break it all down for you. Basically, these investment firms have really sophisticated models, and they're not always perfect, but they have really sophisticated models which tries to predict the returns of each different asset class out into the future. This is an annual return, and it's for 10 years. And 10 years is important because a lot of the times when we think about returns, you and I, we're only talking about this week or next week or from tomorrow, the next day. We have really short-term focus. But the longer you zoom out, the more reliable forecasts tend to become. So I don't think I've got it here in my notes, but the longer you look out into the future, the more reliable it becomes. And I don't have it here in my notes. Now, Vanguard's effectively saying here, and there's so many disclaimers around this, so I'm not going to just take the numbers and just cherry pick it. They're basically providing returns based on historical numbers, based on the current economy and all these different types of things. And the basic takeaway from this is that if you're looking at shares, it looks like the returns that you can expect from a broad share market ETF might be something like 3 to 5%. And if you're looking at bonds, it's going to be even lower at, say, 1 to 2.5%. And if we jump across to BlackRock's forecasts, we can see here that if you go into the more riskier side of things, like Chinese shares or European shares or emerging markets, the return expectations are a bit higher, meaning that these are expected to produce more return over the long term, but they're going to be more risky. In just for standard, a 60-40 portfolio, which might have 40% bonds and 60% stocks, the expected return is right here. It's about, about 6.2% from the central expected return. So it's about 6.2% is what the expected return from investing is over the long run. Now, I'm going to just bring one more complexity into this before we can slow down. When we invest, typically the reason that we invest is because we want to sacrifice money now to have a bigger gain in the future, to have more money in the future. Now, the way that we have to measure that is we obviously have to keep in mind inflation. $1 today is worth less than $1 in the future. $1 in the future is worth less than $1 today, because if we have it today, we could invest and make money from it. And inflation, things going up in value, is going to mean that things cost us more in a year. So $1 in a year is not as valuable to us as $1 today. And so what we typically do is we measure our investment returns after inflation. And with inflation going through the roof, as you can see here, people are really scared that the investment returns they're going to achieve aren't going to be as substantial. So the current inflation rate in Australia is 5.1%, which we see right here. So it's 5.1%. And yet the returns that we're expecting from a diversified portfolio might only be 6%. So that sounds pretty scary. Does that mean we're only going forward 1% per year if everything is true? Well, not necessarily. Because over time, it is a general expectation, I guess you could say, that inflation will probably cool off a bit. And when inflation cools off, maybe it falls back down to 2 or 3% like the central banks would like it to be, because that's more around the long-term average, 2 or 3%. Then the 6% doesn't look so bad, because then you're getting 4%, what we call real returns. So I guess at the end of the day, I'm trying to explain to you here that what we're seeing from the biggest investment firms in the world is that an expected return of around between 4 and 6% is typically likely. Now, there used to be an old school rule called the 7% rule, and I'll just quickly write something here. The 7% rule was this: if you have a balanced portfolio, you can expect a 7% return with 3% inflation. So here we can see there'll be 4% left over. Now, this is why we call it the 4% rule. We see that we've got a 7% return from a diversified portfolio with inflation of 3%, means we've got 4% left over. So for most people, this was the assumption. If I have $1 million in my superannuation, I can expect it to go up at 7% a year I've got to cop the 3% in inflation, which means that I can take 4% out every year and it will keep pace with inflation, right? So 4% of $1 million is $40,000. So this is how we start to think now. Okay, now we're thinking about how can we get income from the stock market. Basically, the stock market side of things is trying to increase, I'll go back here, is trying to increase this part of your portfolio. So it's trying to increase the return. But as we know from recent weeks, it also increases the risk. So how do we try and draw more dividend income from a portfolio while also getting franking credits and do all of that? Well, we can use a dividend-focused ETF, like the Vanguard Australian Shares High Yield ETF. So this is one of the topics for tonight. The other thing that we can do is we can just target individual shares. So I see that Pocketful of Shell has said, I've been tossing up between VHY and a couple consistently high-performing dividend stocks that I can get behind. I'm not into oil and general mining, which VHY holds. Okay, fair enough. Did you know, Pocketful of Shell, that Washington H. Soul Pattinson, which Jeremy just mentioned, which is this one right here, Washington H. Soul Pattinson also has a history of investing in industry as well. So I think that would be worthwhile. I said, Jake, you've got a question here. Hi, guys. I'd love for Owen to explain why VAF isn't paying a dividend this quarter for the first time ever. That's a good question. I haven't actually looked at the distribution history or the distribution notice from VAF, but I could quickly have a look. Jeremy, you've asked a question. Owen, 7% is old. Have you any insights into what we should be aiming for now? Well, this is the thing. If we look Vanguard index volatility, this one is no, that's not what I want. Vanguard index volatility. Does it come up? Volatility charts. Here we go. This is the one that we want. So remember this chart from I think it was 2 weeks ago, Jeremy, where if we look back at the returns of the major investments that we could make since 1970, we can see Australian shares are up on average 9.7%, international shares 9.8%, US shares 11.7%, Australian bonds 7.6%, and cash 7.5%. Now, I don't know what the future holds, but what I would say is that really the reason that I would say one of the big reasons a lot of these things have gone up so fast is that interest rates have fallen. So if we think about that, I would say that returns in the future may be lower than that. So we can see here we can see interest rates falling over that time horizon. And that has meant that property, shares, bonds, all of those things have gone up. So I would say it would be below that. That's just my really a thumb suck. I'm really not an economist, but that's probably what I'd say. So I guess that kind of explains it. Fleur, you've said, they've given me options. I've just ignored them. Early on, others sold options and the price has dropped. I've taken the long-term attitude that they will cost me anything. So, sorry, Fleur, I'm not up to date with what I'm just jumping into that conversation. I don't know who you're talking to about that. My mistake. So, Ray, you've said the 5.1% inflation now. Yeah, so inflation is currently 5.1% here in Australia. Over in the United States, it's a bit more. In the UK, it's a lot more. Now, this is quite normal that we have periods where inflation goes higher. You can see historically how inflation has traveled in Australia. You can see if you go way back into the 1980s, 70s, etc., inflation was consistently this high. So inflation was consistently this high. So that's another thing that's important to keep in mind. Okay, so there are a lot of good questions here that are around about like the companies in general. So I'm going to bring up one final thing, which is this compound interest calculator. If you haven't already plugged this into your life, I would say this is the way to go. So do we have it here? Can you give us a calculator? Let's have a quick look. Money Smart compound interest. This will all make sense in just a second. Here we go. And I'll paste this into the chat. There we go. And in here, let's say that we've got $100,000 portfolio today. We make a regular deposit of $1,000 every month, and we compound annually. And say we've got 30 years or 20 years until we retire. And let's say we compound at 7% per year. There are many assumptions in this. we can see that the portfolio of $100,000 would grow to $878,000, right? Now, if we assume a 4% return, we can see it's only $576,000. So this is why choosing the right investments makes such a big difference. And it's why keeping costs low makes such a big difference. It's why, the great thing is Selfwealth has fixed price brokerage, which wasn't a thing for a long time. If we go 8%, we've got over $1 million. Now, you can have a look at and play around with this compound interest calculator at your will. And I would encourage you to do that, to plug in your own assumptions and what have you. And you can look at the long-term returns of major investments and see how they've gone. So I think, now how do we talk? Let's talk about getting this income from the stock market. So we'll talk about Metcash in just a moment. But for the most part, most investors are now turning towards ETFs and to an extent still managed funds, but mostly ETFs. Remember, back inside Selfwealth, if we look at the top performing members, we see that many of them have ETFs in their portfolio. I'm just going to click on this person. I don't know the top portfolio today. Let's have, I've only got 2 holdings in there, so that's a bit skew-if. So there's probably, some individual ETFs or shares. But if we go to the top members over the past little while, and we go member insights down the left-hand side, and we click on a random one. Let's say one's got 8 holdings. So this is Christopher here. Let's have a look inside the portfolio. So we can see 1 share, 1 ETF, 1 share, 1 ETF, 1 ETF, 1 ETF, 1 share. So we're looking at kind of like an even distribution between ETFs and shares for this top member. And what we've found in recent weeks is more and more people are doing this. And the reason why this tends to happen is because when we invest in one individual share, and this is all going to come together in just a moment, ladies and gents, don't you worry. When we invest in one individual share, we end up taking risk that company might not pay a dividend or it might not produce a profit. And in times gone by, there used to be a chart like this that was thrown around a lot. This is one that I just drew up. But in times gone by, a dividend portfolio would maybe have, say, 30 individual companies around about this point right here. At this point right here, the risk of holding any individual company would be very little, because if one of your 30 companies doesn't pay a dividend, at least you've still got 29 other ones. Now, you will always have exposure. If you invest in the stock market, you're always going to be exposed to the general whims, ups and downs of the stock market. By using ETFs, effectively, what we're about to show is that you can minimize the risk of individual shares and have multiple investments in dividend-paying companies in one go. And so how do you do this? Well, you can use one of the most popular dividend ETFs. I spent my afternoon today looking at the most popular dividend ETFs in Australia, and here's the list. So we've got the HVST ETF, the IHD ETF, VHY, YMAX, DVDY, MVB, ZYAU, and RDV. Now, interestingly, you can see how many individual holdings are inside each ETF. The ETF that has performed the best over the past 5 years, and this data is using ASX data until the end of May 2022, the ETF that has performed the best by far is Vanguard's VHY ETF. Over 5 years, it has compounded at 10.5%. This is dividends and growth. And here we can see over 3 years, it's 11.3%. And none of the other ETFs, maybe you could say the MVB ETF, have really come that close to it. So this ETF, through whatever means, has performed really well. At the current date, it has 66 different holdings inside of it, whereas some of the other ETFs, MVB ETF, which invests primarily in bank shares, has 7. The ETF securities, ZYAU ETF has 40. And you can see the way it all shakes out. The lowest fee ETF amongst the dividend ETFs is also VHY, which is not surprising given it's a Vanguard ETF. But we can see the MVB ETF isn't that far behind. The ETF securities and Russell Investments ETFs aren't that far behind again. We've got IHD at 30 or 0.3%. So these are all ETFs that a lot of people jump at because they think, well, why don't I just invest in one of these ETFs instead of looking at all of these individual shares that I want to buy? So there's a good question that's just come through from Pima. You've asked, what about VLC? Just have to jog my memory on this. So here we've got the Large Companies Index ETF, VLC. It's not an ETF that I'm overly familiar with. Let's have a quick look. If I can search the new Vanguard website, I probably can't find my way around. Vanguard VLC ETF. Let's have a quick look. And if we go in here. So the reality is, as I've spoken about quite a few times on Selfwealth Live now, we can see it's got $157 million invested in. The reality is that many of the ETFs, that even if they don't say dividend in the tagline, they can actually be used for dividends because you have two options. One, you can sell some of your investment to fund your retirement or to fund your dividend stream, or they'll still pay dividends, they just won't pay as much. So a good example is the A200 ETF from BetaShares or the VAS ETF from Vanguard. Both of those have a reasonable dividend, as does this one right here. So here we can see, Pima, thank you for this, 4.9% is the estimated dividend yield of these companies inside this. It's got 22 different companies, and it's got a dividend yield of 4.9%. And if this is an Australian shares ETF, which I believe it is, it will pay franking credits. So it will also pass those franking credits through to the investors. By the way, as you may know, the Selfwealth are currently doing up their annual tax reports. So that's currently going on in the background. And you can use ShareSite to import your holdings into ShareSite and do your tax calculations that way. Another way to do it is to wait for the ETF providers to send you their annual member statement, which should come through in a little while, in the next few weeks. All of the ETF providers will send you a statement at the end of the tax year, after the tax year, so you can hand that to your accountant. So we can see here that the holdings inside this ETF, 22, I wouldn't say that's overly diversified, but if we come down and we look at the individual holdings, let's see what we've got here. We can see we've got BHP makes up 17% of the ETF. See, that's probably too high for me. I like to see a bit more diversification. Commonwealth Bank, 13%, CSL, 10%. So between those three, you've got 40% of your dividend exposure. Now, if you look back at the list here with VHY, it's got 66 individual positions. 66 individual positions. And I think this is actually one of the reasons that it has done so well, is that it is more diversified than the other ETFs focused on dividends. So I hope that makes sense. Matthew, you've written VHY equals very high yield. Yeah, that's about right. So Isaac, you've can you please share a link for the calculator? Good question. PT, you asked, what industries / stocks grow during bad times / recessions? And interestingly, what we might find, I don't think we have a true answer for this, PT, but what I would say is some of the companies that should do well are companies that are in defensive sectors. So sectors, if I bring up the Selfwealth website, so we know the usual names like Woolworths and Coles, energy companies. AGL normally might do pretty well. We've got even banks. Some banks might do well, provided their bad loans don't go too sour. We've got many different companies like this. Even mining has proven to be very resilient lately. So there are many different industries, and within those industries, there are some companies. What I would say is a really good sign, and we've spoken about this quite a bit, PT, is yeah, you got the joke, Jason Marshall, about AGL. There's been a lot going on at AGL lately. Not that AGL, this AGL. So what we've found recently is that companies with lots of debt are being punished. So maybe to answer your question, PT, I'll give you a counterpoint. I'll tell you the opposite. So companies like BWX, which by the way owns brands like Sukin, and it owns a big stake in a more innovative skincare brand known as Go2, which is by Zoe Foster Blake. So this company has lots of debt, has made acquisitions, sells a product to supermarkets and discount chemists, and it doesn't really have any pricing power. So it's no wonder that this type of company has fallen away, whereas other companies might. Jerry Jeremy, you've said it would be interesting to understand if Woolies and Coles price hikes match the inflationary cost of products if they are gaming inflation and benefiting from it. Shareholders may like that. Shareholders may like that, Jeremy, if Woolies and Coles increase prices, but consumers definitely wouldn't. So, interestingly, Woolworths has come out and made a public statement saying that they are actually going to cap the price increases on some essential items. So that's their, I don't know if that's PR or investor relations, if it's public relations or investor relations, I'm not 100% sure. But that was an interesting statement to come out with. So I think like it's something that they could, but we would guess, I guess, that if they do cap prices, it's going to hurt them in the short term. Okay, so quickly getting back to these ETFs. The way ETFs are constructed is actually very important. See, if an ETF has fewer individual companies inside it, what happens is there are two things that happen. The first thing that happens is an ETF may end up selling a big part of its portfolio, which would push the taxable gains and losses back to you as an individual investor. So let's take MVB as an example. You wouldn't use MVB as your sole portfolio of Australian shares because it only has 7 positions. So if you go down to here on the VanEck website, where is it, on the holdings, it only has 7 positions and it's all in one sector, which is banking. So you wouldn't use this as the sole exposure, but you might use this ETF if, for example, you already have a diversified portfolio and you want a small amount of exposure to banks. You might say, I want 3% of my exposure to be banks and I want income from that. And that's where you might use an ETF like this. But what happens is if, say, for some reason, this ETF decides to sell one of these positions, it can mean that the ETF ends up crystallizing a lot of its gains or losses inside the ETF, and you as an investor have to deal with that. Whereas, say, when an ETF has a lower turnover or lower turnover investments inside of it, it can actually be lower tax for you. So that's actually really important. Another thing that happens when you have less or fewer individual holdings is, if we go back to our chart here, the more holdings you have, the more diversified you are, which means that you're trying to eliminate the risk of any one individual company hurting your portfolio. So what we tend to see, it's not always the case, but what we tend to see with ETFs that have fewer holdings, what we tend to see is they tend to have higher volatility, meaning more risk. There's more ups and downs. Now, another thing that you might find from this chart is that the ETFs which have lower fees, not always, but often tend to perform better. Isn't that interesting? Because these returns are net of fees. So after fees, they tend to perform better if they have lower fees, which makes sense, right? So that's another thing that we can try and keep our mind paying attention to. So we've got diversification is good because it means the income that we get from our dividend paying companies is diversified. Lower fees is good, which makes sense. And I guess in general, what we want to do is we want to understand where these fit in our portfolio. If we have an ETF that has only a few core holdings inside of it, we might think to ourselves, well, that's probably a bit too risky to be in my core portfolio. I might have that in my tactical or my satellite exposure. So for example, in this type of diversified portfolio here, inside the green bit, I would have maybe the Vanguard VAS ETF or the VHY ETF, but I wouldn't have one of the more expensive dividend ETFs in the green bit. That would be around the outside. So I guess at the end of the day, the market has kind of decided that VHY is the premier dividend paying ETF, but there are other reasons to look at some of these other ETFs. For example, this DVDY ETF, I don't know if you're familiar with this, but this ETF tries to combine dividends while also looking at companies that have, according to Morningstar research, a lower chance of default and wider moats and more defensive characteristics. So inside this ETF, there's a really interesting list of names. So if we come down here, we can see we've still got Commonwealth Bank, we've still got all the big banks, but we've got things like NIB, and Aurora, the packaging company, or Sonic Healthcare, TPG Telecom. These are all businesses inside this dividend ETF, which you probably wouldn't expect from some of the more kind of big established companies. There was one other ETF amongst this list, which I thought was very, very fascinating. Maybe I'll just answer this question about BetaShares YMAX really quickly, because I know we get a lot of questions on this ETF or managed fund. This is a bit different. The way this works is very, very different to a lot of other ETFs. So how can I explain this in as quickly as I can? So let's come back to me for a second, and I'll just drop this for a second. So inside of this ETF, what it actually does is it buys 20 shares and it holds them. And then what we call in finance, it writes options. So it sells contracts against these 20 shares. And when it sells these contracts, it is agreeing to pay whoever buys that ETF, it buys that contract, sorry. It's agreeing to sell the shares inside at a certain price in the future. So that price is higher than the current market price. And when it does this, it's basically saying, here you go, here's a contract for these shares. You can buy these shares that I've got in the future if the price rises to this point. Now, what I do is if I own those shares and I write those contracts, is I collect a small amount of money every time I write one of those contracts. It's like I'm saying, I will sell this to you in the future, but you have to give me a tiny little bit of money right now. This is what this is it's called a covered call option. And it's actually a really interesting strategy, because what BetaShares tries to do from this is they try and hold the 20 shares, but then also make money from selling the contracts over the top. And that's why we can see that the returns from this are quite strong, even though it has only 20 holdings and it has a higher fee load. So it's quite a fascinating ETF. Actually, it's probably incorrect for me to call it an ETF. It's more of a managed fund. It's more of an active strategy, but you can see the returns there. For me, it's probably something in my portfolio that I don't really need, but I do think it's interesting from an investment perspective anyway. I know we get a lot of questions on that, so that's why I bring it up. So Pima, you've said covered call. Yeah, so a covered call is basically they're saying we already own the shares, so it's covered, and we're selling call options against it. So I hope that makes sense. Jeremy, you said, oh, and options are a much shorter term strategy, right? Yeah, that's right, Jeremy. Typically, options contracts are measured in months, not years. They can be measured in years, but typically months. So there's a good question here. Chris, you've said, looking at the 10-year performance in Selfwealth for VHY, it's very up and down and doesn't seem to have much growth. Is it possible to explain how it's had 10% per annum growth when the graph doesn't reflect that? Great question, Chris. And it seems you're not the only one that has this question. So if we look at VHY, now, if we look at this, we can see here, it looks like it's mostly flat. There's this part down here, which is $48, and it's currently, what is it currently? $64. So it's gone up over 10 years, but it's been mostly flat with a bit of like a zigzagging across. Now, the reason that happens, Chris, is that when I quote my returns, where are my returns? Here. When I quote my returns, these are total returns. So this includes the income or the distributions that people receive. So when we look at, say, this right here, what we find, and this is a different ETF, by the way, but what we can see here is we can see the returns quoted here too, right? Now, we can see returns assume that investor purchased shares at the price and does not reflect any transaction costs, brokerage, or bid-ask spread. That doesn't actually explain it, what I was going for. But basically, what we are including is the income that comes from the investment. Now, I think one of these providers actually do a fantastic job of this to illustrate how this works. It may be VanEck that does it. I'll have a quick look. One of these ETF providers does it. Yeah, here we go. VanEck does it right here. So this is just for their DVDY ETF. Okay, and we've only got a shorter term time horizon to look at this, Chris. But here we can see that the price of this ETF over 1 year is actually going backwards. So if we looked at the chart, it would go backwards. But the income that's received from it is 6.08%. So for a total of 4.36. I think is that now starting to make sense, Robbie? and Rose? Is that starting to make sense? Now, if we look at another ETF that they've got over 5 years, we can see that the price has only gone up at 2.62%, but the income return has compounded each year at 4.77 for a total return of 7.39. So that's how we get back to the returns that you see down in here. So a lot of investors aren't aware of this and they buy these ETFs thinking, oh, look, this is a terrible investment. It's gone down. How terrible is this? Not remembering that they actually have bought an ETF that isn't designed to go straight up like some of the other ETFs are. It actually is an ETF that if it just holds its own with the market, it might be doing okay. So that, I think, that is starting to make sense for you now. So these ETFs, remember, are targeting dividends. So the dividends that you are receiving every quarter or every 6 months or every 3 months, one of these ETFs pays dividends every 4 months, which is a bit of a weird, unique cycle. And they're just passing that back out to you. But those are still real things, right? Remember how we talked about, remember how we mentioned, I think this was a few weeks ago, we mentioned how if we measure the stock market as a whole, if the stock market went up 10% on average, let's just say 10%, that's 10 points if you like, 6 of those would be from the growth or the capital gains going up. The other 4 is from the dividends. That's like long-term averages. So if you got a 10% return, you could almost assume from a broad investment that nearly half of it is from dividends. And then if we add the tax benefit of franking credits on top, there's even more reason to account for those dividends, so to speak. So I hope that makes sense. Jeremy, this is your joke of the evening, I see. Did I hear that Vanguard and Van Eck are merging? Their new name was NeckGuard. Well, if an ETF provider comes out with NeckGuard, I'll buy you a nice bottle of red wine there, Jeremy, because that would be something to pull off. There is, however, a merger that is going on in the ETF landscape. I don't know if anyone's seen this yet. There is a big merger that's currently underway, which is between ETF Securities and a company called Global X or Moray. So that's one of the ETF providers globally. So ETF Securities. Nothing changes with the ETFs, by the way. It's just interesting. Okay, so now that we've talked, I've banged on and on and on about using this VHY ETF or something similar to it. It's important to remember if you do invest in one of these and you are trying to compound your wealth, you want to set up a dividend reinvestment plan or a distribution reinvestment plan. And you can find the details in the PDS, which is on the website. Because you want those dividends, typically most people, not everyone, but a lot of those people that are in accumulation mode want those dividends to be reinvested. Now, if I was investing in one of these, low-cost ETFs, again, just to re-emphasize this, it would probably be in this Australian shares part of my portfolio. It wouldn't be the whole thing though, right? It'd probably be one of 2 ETFs, say, or one of 3 ETFs that target this. That's the way I'd think about it. I've only covered the dividend ETFs for the Australian shares part of this. There are dividend ETFs that target international shares as well. It's just that typically in Australia is where you get the best dividends. Okay. So, Shergill, I think it is. You just mentioned, just before I get into, just quickly here at the end for Metcash, you've mentioned, what do I think of the quality ETF? This is an ETF that's just come out from Beta Shares. This ETF is very, very similar to the other ETF called Qual. Now, this is an ETF that I've followed for quite a few years, and it's an ETF that I quite like. It is an ETF that invests in 300 companies. I think we did this in a separate session not too long ago. If someone does want to jog my memory on this, we did actually cover this Shergill not too long ago in a session. The Qual ETF is a very popular one from Van Eck, and it's probably the more established of the 2. So I think the new Beta Shares one is slightly cheaper, however. Okay, so let's talk about Metcash. In our poll inside the live chat, we've had 152 votes I can see here. And it's where do you shop for groceries most often? And 41% of you have said Coles. 33% have said Woolies, 8% independents. So that's interesting because when I was trying to figure it out, where everyone shops in this country, Woolworths in all of the studies dominates. So Woolworths, we can see here, has 37% market share. followed by Coles at 28%. There are a bunch of independents or other in 16%. Metcash at IGA at 7% and Aldi at 10.5%. Now, if baby boomers love Woolworths, then Coles, then Aldi. If we go to Gen X, we can see more Coles. If we go to Gen Y, Woolies still number one. Gen Z, even more. Everyone loves the fresh food people, they say. And so it's a really interesting thing that, and there's actually one other thing that I will bring up here, was the different states, how much they spend. This is all data from Finder and from other sources that they quote. New South Wales pays the most for groceries. We can see that Tassie pays $148 on average, even though it's landlocked. Even though it's in the ocean, and it has to get across there somehow. Must be all the local produce, we can say. So anyway, so I looked at the results from Metcash this week. Metcash is the owner of IGA, Home Timber and Hardware, and a bunch of other brands like Mitre 10. And if we go to its most recent results, and we can see the presentation here, we can see the company has basically come out and it's issued some really good results. It said our revenue was up 6.4%, our operating profit was up 17%, our cash flow was positive, we've produced more earnings per share or profits per share, and our dividends for the full year are also up. So if we scroll down, they've said, well, this is a great result considering, all these things. We've had COVID, we've had the floods, we've had the Russian invasion of Ukraine, we've had China lockdowns, and we've survived. And if we look at, this is something that I always like to do when I look at any company, is say, okay, you've said revenue's gone up, profit's gone up. Well, what drove that? And so here we've got the results by each individual segment within the business. Now, what's really interesting here is we can see that for revenue or sales, we can see that the food business only went up 1.4%. But the hardware business, if you haven't been trying to buy timber flooring or something like that recently, I can assure you that prices have definitely gone up. So this is one industry that has seen a lot of inflation. Even the price of, say, steel has gone up tremendously. So here we can see the price of the hardware division reporting heaps of sales, $3.1 billion. Liquor has also gone up. Now, if we come down and we look at the profits per division, we can see that the profits for the hardware division are up 40%. The food division, even though revenue only went up 1%, we can see the food division did report a 4.1% increase, and the liquor division nearly 10%. So that means that there's something going on there. They're actually reporting pretty well. And so here we can see that Metcash is basically, its results have been supported by the hardware division. So if we go down to the hardware division, let's have a look at what's going on. If we drop down, we can see here the total sales increased 21%, $3.1 billion. And we can see all of the different businesses kind of contributing here. We've got Total Tools, IHG, we can see up 9%. One of the things that I like to look at is this figure here, LFL, which means like for like. It's basically adjusting for any increases in stores and that sort of thing. We can see here up 9%. We can see 22 new or expanded sites across the network. We can see an acquisition of 20 joint ventures as company-owned stores, which brought in $95 million of sales. So that explains some of it. We can see online sales are now 6% of the total. And if we keep going down, we can see Total Tools still increasing sales. We can see like-for-like sales growth of 5%. So if we keep down again, we can see more and more and more of the performance from these different business units. Now, I can see a comment in here from Martin Schoen who says, Coles is closer than Woolies, 6 of one, half a dozen of the other. I'm kind of with you, Martin, but it's interesting. I believe 22% of Australians choose to shop at a supermarket based on its proximity, so how far away it is. So nearly a quarter of us base the decision solely on how far away it is from us. So the more supermarkets, more basically. Jason, you said, I always loved it about Aldi, just getting the milk, sugar, and hey, a lawnmower. Yeah, it's really interesting. And this is the thing. Like I used to when I was going through school, actually, I worked at an IGA/Foodworks, which was owned by Metcash, and I got to see a lot of the changes that have happened over the years pushed through. Now, Metcash has claimed that, and what's been reported in the news is that it is taking share from the big players. It's actually increasing its market share. But the thing is, really, I think in Australia, from my 2 cents, it seems to be a tale of three horses. It seems to be a tale of Coles, Woolworths, and Aldi. Aldi, as you can see here in the Finder notes, it says Aldi has a smaller market share of 11%, but it has been growing rapidly, up from 4% in 2009. So we can see all of these different, websites will report something different. But at the end of the day, we can see that the two dominant players are probably the ones that are still just fortified in their positions. So someone asked before about companies that will do well even in a downturn. Well, people still need milk and bread. That's kind of the general sense here. The other thing is Aldi seems to have taken a lot of share from smaller incumbents as well. So other players outside of the two major supermarket groups. So Aldi is as much a threat to Metcash and IGA as it is to Woolies and Coles. You may remember a few years ago, there were other entrants into the Australian market which tried to take share. Some of them since retreated. So that's a good sign. But one thing that I've found in investment markets over the years is that in most industries, typically you have one or two major players, and then you have a third one which might do well, but it's the fourth and the fifth that really struggle to make consistent profits. Now, this is not just peculiar. This is not just a peculiarity of the supermarket industry here in Australia. It tends to happen across the place as well. Which leads me to my next point about Metcash. Metcash has a really, really powerful hardware business, and we can see that. If I was looking at if we go to the financials, if I was looking at Metcash today, what I'd be wanting to know is how much of the sales growth in recent years is explained by the hardware offering that the business has. Because we can see in the charts, if we come back here, where is it? Here it is. If we look in the charts, we can see that the hardware business is the thing that keeps doing really well. So here we can go for the first 7 weeks of FY23, sales have increased 19.8%. Continued strong growth in IHG and Total Tools, acquisitions, and the impact of higher inflation, which is around about 10.4%. Strong demand and global supply chain challenges are continuing to place pressure on the availability of some products. There continues to be a strong pipeline of residential construction and renovations activity. If we think about industries that kind of consolidate around a few leaders, Metcash's push into this space is probably something that investors should be watching out for, because if we imagine that this industry, which is the supermarket industry, turns out to be something like the home DIY and trade market, I think it's important to remember that Bunnings has the biggest share of this industry, and then there's Bowen's, and there are a few others. But maybe Metcash can continue to reinvest in its hardware unit and continue to drive its shareholder returns that way. That's something that I would be looking at, and something that I am looking at going forward. Because even though these growth rates probably aren't sustainable, because there's a lot of inflation coming through, it probably will be something that continues to show growth. Because a supermarket should really only grow its sales at 2 to 3 to 4% per year. Whereas a hardware business that has a lot of opportunity may be a business that can keep growing and keep bringing new products and keep basically capitalizing on rising prices in construction. So that's a bit of a different business model there. Frank, you've said, with high fuel prices, I would expect more people to shop in Metcash shops, which are often in smaller locations. Yeah, Frank, maybe I would probably agree with that too. Akadaki said, Coles has better and bigger online website and delivery is cheaper. In residential areas, I do find that Coles is easier for us to get here in the outer east of Melbourne. Pocket full of shell, you've said, wonder if HelloFresh and others have hurt supermarkets in any way. They're probably owned by Woolies. Some of the big big food delivery, like box delivery of food, some of those players have done pretty well, but a lot of them, Shell, have actually done pretty poorly because it's actually a very, very uphill battle. So here's not them. Marley Spoon here in Australia, we can see financials revenue going up. Let's look at the stock price. 1 second, going down. Now, why would that happen? If we go back to financials, revenue is going up. Let's have a look at the costs, also going up. Let's have a look at their other costs that aren't captured in that one. So costs also, well, it's not too bad. So then if we look at this line item right here, this is basically measuring your operating income, which is like the profit of the business. We can see still negative, still very, very negative. And a question that's often asked of these types of businesses like HelloFresh or Marley Spoon is how do they get their pricing power? How can they increase prices and keep users sticking around? So I guess that's the trick, isn't it? So at the end of the day, for me, I think Metcash is a good business. I think it's a really respectable business. Would I buy it solely for dividends? Probably not. There are a few things that I would like to do to research it first and to make sure that its dividend is rock solid. One of the things that I like to look at is how strong is the cash flow. So we can look at that if we go here into the annual report. And by the way, we're almost done, ladies and gents. You've got things to do on your Wednesday nights. If we come down to the statement, to the cash flow statement, which I'll bring up in just a moment if I can find it. So much reporting that goes into annual accounts these days. So if we come down to the cash flow statement, we can see here, and I'll zoom in, we can see here the company has produced $432 million of cash from its business. For things like its acquisitions and for all the other stuff it's got going on, it's got to pay 120 of that back out. If we go down a little bit further, we've got the leases that it has to pay. So if we've got 400 minus 120, what's that? 300 minus 150 for the leases. It's about $150 million of net cash that's available in the business. So that means it's positive. It's in a good part. It's in a good state. However, it is also paying nearly $200 million of dividends. So if we've got $150 million coming in and it's paying 200 out, we've got to make sure that the company continues to drive its cash flow higher to make sure that its dividend is sustainable. Another way to measure dividends and see how sustainable a dividend is, so the last thing that I'll get to, is if we look at the earnings per share, this thing right here, diluted earnings per share, and we compare that to the dividends paid. That's called the payout ratio. So how much does it pay in dividends versus its earnings? So it earned 24.9 cents per share. And we saw before in dividends, if I go right back up, we saw before in dividends, it paid 21.5 cents per share out. So if I just do the quick math in my browser here, maybe I'll use this one, 24.9 minus 21.5, just like this, means it's left with 3.4 cents per share to invest back into its business. So, you've got to then calculate, well, how much is it keeping inside the business to reinvest? Does it need debt? How is it financing that? For me, if I was going for dividends, at the end of the day, I would use something like the VHY ETF, which is why I want to add that to the low tofu portfolio. Here, we can see it in here. So I want to add that to the portfolio. So to my virtual account, I've got $64 with my $1,000 hypothetically invested. That's 15 or 16 shares that I can add to it. So how much was it? 64 VHY. It is $64.11, and I can get 15 of those. So I'll put that in my portfolio. Add holding VHY, and we want 15 of those. $64.15, I think it was. Boom. There we go. Added to the portfolio. Here we go. We've got Vanguard in the portfolio. So we've been through a lot tonight. Thank you for everyone that's stuck with me. I do have one more final thing I want to share with you, and it's about investing in general. A lot of people have been very scared lately, so I thought a very good quote from Mark Twain would suffice. And the quote is this: "I've suffered a great many catastrophes in my life. Most of them never happened." Mark Twain. So I think this is a really interesting quote for right now, because when inflation is high, the stock market is falling, people are worried about their jobs, prices are going up because of inflation. Everyone thinks, geez, it's really scary. I should sell now. I should run for the hills. All of these different types of things. In investing, a lot of the times we see really negative forecasts on the horizon. It is so much easier to sell a newspaper or to sell something if there's something negative in front of us. It just captivates our attention, particularly when money's on the line. And I see this all the time, even with the best investors, that a lot of them say, oh, this is a very scary time. It's very scary. I think the stock market's going to keep falling. And then you ask them, well, how much is it going to keep falling? They're like, I don't know. It's just really negative. And a lot of people fret over things that actually never eventuate. So that's why I think this quote is really apt right now. Thanks, Ben, for tuning in. For everyone that has tuned in tonight, I'd love it if you can give us a thumbs up or subscribe to Selfwealth on YouTube. It makes a big difference, and you'll get a notification the next time we go live, which will be next Wednesday at 6 p.m. I'm hoping to have a special guest with me next week. Please, if you have time right now, I would love for you to name some of your guests that you would love to see on the show. Rob and I can reach out to them. Rob and I love to get your feedback and try and find some guests. I've got some guests I think it was about a month ago, some people put something in the comments around some guests that we could get on the show. So if you do have any special guests, people that you see on the news, CEOs, investors, whatever, we can see if we can have a chat with them. We can see if we can get them on a show. Jason, you've mentioned Peter Thornhill. That's a really good one. If we can get Peter on the show, I would love that, Jason. If you have a personal connection to Peter, let us know and put us in contact. Jeff Wilson says, rare. Yeah, Charlie Munger, Matthew. Wouldn't it be nice? Imagine if we could get Charlie Munger from the United States to tune in. He tuned in for the Sown Hearts and Minds conference, didn't he? Elon Musk, Warren Buffett. Yep, Kenny Griffin. There's so many. Okay. Well, I will take all of these on board. I will try and get some of them. CEO of Argo Investments. That's a really good one. Dev Jani. We could try and reach out to someone like that. Thank you. So Rob says, I want Madonna on the show. Well, Rob, this can happen. We can try. We can try to do this. Thank you, everyone, for that dialed in tonight. I hope it was pretty informative. We went through some really technical stuff tonight, which I don't normally like to do, but we went through dividend ETFs, which are pretty popular right now for people seeking income. We talked about Metcash and how it is a really interesting business, and that hardware unit in particular is really catching me. It's really taken my fancy, because I think that has a long way to go. Mark Burris says, Leone. Okay. Charlie Aiken. I have spoken to Charlie Aiken quite a few times, Martin. We could try and get him on the show. Monash Pabrai. Geez, that would be nice. Imagine the views if Madonna was on, says B. Caddis. Yeah, imagine. Well, that's on Rob. Rob nominated that one. So, okay. Thank you, everyone, for tuning in tonight. It's always so much fun to just talk investing and to have you all with me. Don't forget, before the end of the financial year, Selfwealth have the premium sale. Selfwealth Premium. You can see it there on the screen in front of you. Just $240 until June 30th. It gets you a bunch of trades plus access to all the data that I use here on the Selfwealth Live. It's pretty affordable when you consider everything that you get. So thank you, everyone, for joining us tonight. Don't forget to hit like and subscribe, and I'll see you next Wednesday. In the meantime, be sure to send us your requests. These DJs are taking requests, so send us your requests for special guests or for topics. The more the merry. Thank you. Have a good night.